We have a very distinguished panel today to talk about the U.S. equity markets, but I think we're going to talk about the global markets as well, if we can dig into it. So let me introduce our panelists. I'm going to go alphabetically. We have Adam Johnson. Adam is the publisher and founder of the Bullseye Brief. If Adam looks familiar to you, he should. Many years on Bloomberg TV, and we're very happy to have you here as part of the panel.
Thank you, Bill.
Matt McAleer is the Director of ETF Strategies at Cumberland Advisors. Jeff Sott, Chief Investment Strategist for Raymond James. And Jeremy Schwartz, Director of Research for Wisdom Tree, and I believe all things equity. Yep. Good, thank you. So to kick off, I'd like to put this question in the context of two themes that we heard this morning. Dr. Leo Chen talked a little bit about recency bias. And then we also heard this idea of normalization of what's happening with policy rates, the shrinking of the Fed's balance sheet, also known as QT, or quantitative tightening. And we also heard this notion of a flatter yield curve, which tends to be okay until flat inverts, because that tends to be pretty negative for the equity markets. So in that context, coupled with the fact that the S&P 500 index total return since March of 2009 is just about 300%. I'd like to ask our panelists, all four, and we'll just go down the row starting with Jeff, what is your outlook for equity markets? Are you concerned about the normalization of interest rates? And what are you telling investors in terms of equity outlook for the next 12 to 18 months?
Well, if you talk to most talking heads on CNBC, they'll tell you this is the second longest bull market in history, and if you're using 20% up is a bull market and 20% down is a bear market, I guess, they're correct. But secular bull markets are long-term things. 1949 to 1966, secular bull market. Were there pullbacks? Yeah. The Jack Kennedy steel crisis in '62, where the steel companies raised prices, and President Kennedy said, no, you have to put them back down. Markets didn't like it, and they lost 28% in about 6 weeks. Market peaked in '66 and basically went into a trading range for 16 years. If 20% up or 20% down are bull and bear markets, there were 9 bull and bear markets within that trading range. And then we break out of that range in '82, and you start the '82 to 2000 secular bull market. Were there pullbacks? Yeah, there was the crash in 1987, but it didn't stop the secular bull market. I think we're in a secular bull market. I actually think it began on October 10th of 2008, when 92.6% of all the stocks traded made new annual lows. I've been in this business 47 years and looking at markets with my dad, who was a portfolio manager for 55 years. I've never seen 92.6% new annual lows on stocks. So I think the first leg of the secular bull market began there. I think it ended in May of 2015, and then we went into this upside consolidation, and the bears came out of the woodwork and said, massive rounding top, the market's going to crash, we're going into a recession, earnings are never going to recover. And I think the second leg began when Royal Bank of Scotland told you all to sell everything, and that was in February, except high-quality bonds, in February of 2016. How long the second leg lasts is unknowable, but it's usually the longest and strongest, and it's when earnings start to do this, and it's when the economy starts to pick up. When the second leg ends, we'll go into another upside consolidation, or we should go into another upside consolidation, and then break out of that and go into the third leg. The third leg of the 1982 to 2000 secular bull market began in late 1994 and lasted to the spring. So if you want to start in October of '08, if you want to start in March of '09, this thing still ought to have 6 or 7 8 years left in it, and hardly anybody believes it. I'm not worried about the Fed reducing its balance sheet because I think they're going to do it very slowly. I think rates are going to rise, but I think they're going to rise at a glacial pace. I don't think it's going to disrupt the economy, and I think, people are still fearful of the equity markets. I've never seen the investment sentiment change so fast from really positive to it's 2008 all over again. So I'm very constructive on this, and I put a lot of money to work, my own money to work, yesterday morning.
Put your money where your mouth is. Jeremy.
Yeah, so earlier in the day you had a technicals panel following price momentum. I focus a lot on earnings and valuation changes as what's driving the market, and a lot of people say this has just been a Fed-driven market, so the Fed's stepping off, so now the market's not going to have any support. And if you actually look at what's happened over the last 7-8 years, it's not been just a Fed-driven market. Actually, earnings and cash flows are up. Markets haven't got that much more expensive when you look at price to dividends, price to total buybacks. These price to cash flow metrics, yes, some P ratios have been rising the last 5 years, but in general, we actually have been seeing dividends and buybacks increase with the price changes. So when I think about where are valuations today, valuations relative to bonds, people say, well, yeah, relative to interest rates, and yes, interest rates are still historically low. If you look at the equity premium, it looks at the earnings yield on the market, so take a 20 PE ratio today for stocks. That's sort of conservative where the S&P 500 is today based on the estimates for this year, the tax changes, the estimates today around 20 PE. 5% earnings yield. Where's your real bond yield? Your real 10-year bond yield is 70 basis points. That's a 4% plus 4.3% equity premium. My mentor, Professor Siegel, has got 200 years of data, studied under him. He says the long-term equity premium is 3. So you're at a 4.3 equity premium. It's higher than normal. If you have a stock-bond mix, you should be overweight stocks, underweight bonds. So the 70 basis points, 10-year tips, that's one of the things. Now, if the more rates rise, when you saw the market sell off in February, the more rates rise, equities get nervous, inflation's coming, yields going up. That's what's causing nervousness in the equities this year. But generally, I think PEs are normal, not overly expensive. What's more expensive is sort of this historically low bond rate.
Adam?
So I thought I was going to be the bull here. and Jeff's even more bullish than I am, and it sounds like you are too, Jeremy. I'm eager to hear what you have to say, Matt. So my whole thing, and I have been saying this almost ad nauseum to my subscribers or whenever I go on a radio show or a television program, the 2 E's of earnings and employment are an incredibly powerful tonic for stocks. That's my line. And I do believe it. I believe it's incredibly robust. Think about it. We have the most number of people ever making the highest gross adjusted income ever, and they are spending that money. And 2/3 of our economy is consumption driven. So if you have that number of people spending that kind of money, that's why you have earnings growth, well, tax cuts as well, of this year 20 to 22%. So again, earnings and employment, that's the linkage. People are making money, they're spending money, that benefits companies. I am not someone who trades the market. I'm a stock picker. So in my portfolio right now, there are 51 positions, 48 of which, actually 49 of which are long, only 2 shorts, the TLT and Nordstrom's. My mentor of many years, a guy by the name of Ed Hagem, so for any of you out there who ever remember a firm called Furman Sells, he ran that brilliantly and sold it to ING at 7 times book, which is still mind-boggling. Nonetheless, he asked me once, and this was the interview question that he would give everybody. He would say, how do you make the most amount of money on Wall Street? And from his point of view, the correct answer was find a theme and leverage it. So I've adopted that as my own. The 2 E's of earnings and employment, that's my framework for understanding the economy and the market. Great, I'm bullish. Now let's go find some stocks that leverage my bullish view. And thematically, there are a couple of things that excite me right now. The electric vehicle build-out. Incredibly powerful. It's not just lithium or copper, it's also the sensors. So there's semiconductors that play into that. There's Albemarle, the largest lithium miner. There's a handful of little $1 and $2 Canadian junior miners, high-risk stuff. But it's fun to sprinkle a couple of those in. I look at what's happening with 5G, and the reason 5G is important is because we're switching to 5G where the frequency is microwaves. And microwaves move very quickly, which is why you can move so much data. But it also requires whole new equipment. So that's why you look at a company like Qorvo or Qualcomm, Nokia, the comeback kid. You see what I mean? I look at themes and then I try to figure out stocks that, or I should say companies, businesses that leverage those themes. So I'm a bull. I guess I'm not as bullish as Jeff, but I certainly admire Jeff's expertise and agree with him that we've got a long way to go on this one. And that gives a guy like me plenty of opportunity to go out and find good stocks to build wealth for ourselves and our families.
So Matt, it's like going to the dinner party and everyone orders grouper. You gonna order something else?
They scare me to death. There's a couple catchphrases you hear out there. What do I think the global markets will do over the next 18, 24 months? Fluctuate. That's what the global markets will do. There'll be opportunities on pullbacks. There'll be opportunities to let go of equity on rips. We trade at Cumberland Advisors. David and I manage the equity portion of our strategies. We trade real money in real markets in real time. And the markets very often will tell us how to allocate that capital. So while I would say that I lean bullish right now, that's a reflection of how we're positioned, right? You can be bullish, you can be bearish. What it ends up being is how is your portfolio positioned, right? I know a lot of bullish people that are heavy in cash. I know a lot of bearish people that are fully invested. Just to give you an idea of where we're at in our U.S. ETF portfolio, because this gives you a picture of any of what my comments will be. That's why I mention it. David's the lead manager of our U.S. ETF portfolio. David comes at the markets with tremendous years of fundamental and macro study. One of the top interest rate guys in the country. I try to complement that with an idea of taking David's thoughts and how can we leverage them? What can we buy? Where can we buy it? How much we should own? So in the U.S. ETF portfolio, I mentioned we're fairly bullish. We are fully invested. We have 1% cash there. We attack it in a 50% manner, core satellite. 50% is in indexes. 50% is in industries and sectors that we feel can give us some alpha going forward. In our international portfolio, and then I'll throw it back to you, Bill, bullish as well. We have a little bit of cash there. We're 4% cash currently. That is, versus our benchmark, we are heavier on the emerging market side. So we're right now sitting at about 60% developed markets, 35% emerging. So when I mention that we're heavier developed, but versus our benchmark, we have a larger piece emerging. And I like how they're trading right now. Then we have Leo went over his quant strategy. That's a separate strategy, math-driven. What I think, what David thinks, what Leo thinks, doesn't matter. The math inputs are going to give us our buy-sell indicators, and Leo, Dr. Chen's strategy. So our third strategy is a tactical strategy. Tactical strategy can be in any asset class: equities, fixed income, commodities, currencies, cash. For the last couple of years, it's been very steady. It's been about 60% U.S. equity, 40% international equity. That's been the breakdown. Bonds haven't passed the relative strength test there. We don't have a bond piece. Right now, where are we? We are 50% U.S., 30% international, 20% cash. So in our tactical strategy, which leans a little more on trend, relative strength, different inputs than a straight fundamental strategy, we started raising cash. You've never heard anyone say they were wrong, and you probably think the same thing here. We did start raising cash in January. We saw some trading situations. David and I sit right in the trading room behind our traders. We saw some situations that's very unusual in the equity market in the third week of January. We saw offers wanted. Very, very strange term. Some traders may have heard the term bids wanted. Has anyone ever heard that term? Bids wanted? When you're trading bonds or trading commodities or trading equities, and the selling is so ferocious that brokers have to put out messages, bids wanted. In other words, I have a ton to sell, just get me a buyer anywhere. You want to be that buyer. You've gotten to the point where you've wiped out much of the emotional selling, and you want to be a buyer on bids wanted. We were getting offers wanted the third week of January in the equity market. So even though everything looked good, we jumped to 20% cash and tactical. So it's managed a little differently. Again, one's not better than the other. They're different. Passive's not better than active. Active's not better than passive. They're different. So that's where we sit now, and that will probably give some color to some of my comments.
Good. Thank you, gentlemen. I want to pick up on something that Adam briefly mentioned, the tax law change. So with regard to the Tax Cut and Jobs Act of 2017, there's a big debate happening right now. Is all that extra cash flow going to go towards investment, or is it going to go to financial reengineering? And how do you think either one of those decisions by corporate managements will impact the stock markets? So, Jeff, do you have a view, or anybody want to jump in on that?
Let Adam start that.
Okay, so the tax cuts obviously had a huge impact on corporations. They also have a huge impact on people. So I just want to say briefly something about each, and that would be, curiously, the savings rate actually in the first month since the tax cuts took effect, which call it February 15th, has been higher. It's like people, they're getting this money and they're not spending it yet. Maybe it's just because they don't know how they want to spend it, or they just want to wait and see how it feels. But, the average American just got a pay raise of, depends upon who you talk to, but it's somewhere, call it around 3, 4, maybe 5%. So that's fascinating. I think that will get spent because we are a nation of spenders. Be it good or bad, we just are. That will get spent. I think that will help to drive GDP significantly higher. If you look at the past tax cuts of, call it, what was it, 03, 04, Jeff, you're a market historian, and then in the 90s as well, CBO significantly underestimated the GDP impact just on people spending. So that's point number one. And I think really where your question was focused, so forgive me for kind of going down a rabbit hole there, though I think it was an important rabbit hole, is how are companies going to spend that money? Are they going to go out and buy more stock? Yeah, probably. I wish they wouldn't, because that's just engineering earnings higher, right? Because you're lowering number of shares out there. So by definition, this pool of earnings divided by fewer shares means your earnings per share went up. That's a gimmick, but they do it. And they are starting to get penalized for it. I think there will be some of that. I'd like to see more M&A, except that with valuations where they are and where M&A is happening, I think it's kind of expensive, so I don't think we'll see a lot of that. But I am intrigued by some of the survey data that suggests corporations are. You look at some of the small business. Gosh, I can't say the acronym. The group that looks at small businesses. Pardon? Thank you, NFIB, exactly right, Jeff. That the NFIB surveys suggest that small businesses, anyway, are going to start allocating capital faster and more aggressively than they have. CapEx, I love it because that extends this whole business cycle that we're talking about. So I do think the money's going to get put to work.
I'm going to go Jeremy and then Jeff.
A lot of people hate on buybacks. This is financial engineering is what gets thrown around a lot, that they're just goosing up the earnings. But you go back, it is shareholders, the shareholders own the companies. You're getting cash flows from the companies, whether it's dividends or buybacks. Buybacks are really no differently in theory than dividends. We don't hate on dividends so much when people return cash through dividends. Why are buybacks so hated on by either the media or analysts? Well, you can say, where did that come from? If we go back into the 1980s, pre-1980s, companies used to pay out 60 to 70% of their earnings as dividends. a lot of that hasn't changed today. We're just doing equal amount of buybacks as we are dividends. Now, why is that? Some of that is, well, companies got to incentivize their executives with stock options, right? You pay stock option, the dividend, when you pay a dividend, price goes down by the amount of dividend, so your stock options become worth less. But in theory, the dividends and buybacks are really the same. Companies aren't doing that much different. I don't think there's really this financial engineering going on. They're just responding to tax incentives that you can defer. You got to pay your tax right away on the dividends. With buybacks, people can choose when they sort of pay the taxes. And so it's tax planning. But I don't think it's this pernicious financial engineering, malicious in any real way. It's just a way that companies are returning cash to shareholders. And as a shareholder, you have the right to the cash flows of the company. So just one comment on that.
Jeff?
Yeah, I'd like to touch on some of the points that Adam talked about. Before the corporate tax cuts, the S&P, Standard & Poor's Corporation, had an estimate bottom-up operating earnings for the S&P 500 of around $141 for this year. That's up to roughly $156 as of Monday of this week. And next year, they're somewhere up around 173, 174. Earnings momentum looks really strong to us. The valuation question, you have more high growth stocks, high margin stocks in the S&P than in history. By definition, valuation should be higher than the historic norm. You've also had a tectonic shift from tangible assets on corporate balance sheets to intangibles. So back in the mid-'80s, 83% of the companies had, or 85% of the companies had tangible assets on their balance sheet. Delta Airlines had airplanes. Now 80-some% have intangibles. So what's an intangible asset? Well, Facebook has 2 billion users. What's it worth? It's worth a lot. Can't carry it on the balance sheet as an asset. Clearly, intangible assets should have higher valuation metrics than historic norms. I would also suggest under the new tax law, companies are going to accelerate amortization and depreciation, which means PE valuations historically might not mean nearly as much as they have in the past. CapEx, I'm a big believer in CapEx. You're starting to see a pickup in that. Under the tax law, you buy a new piece of equipment, you can expense it in the first year rather than depreciate it out over a 7-year period of time. So I think the U.S. economy is stronger than a garlic milkshake.
If you need to Google that, feel free. So let me pick up on the Facebook, the bullishness. Can we have a continued bull market if the FANG stocks don't participate, or they participate less than they have in driving equity prices in the last several quarters? Anybody want to take a crack at that? Matt?
Sure. I think so. You know, we've leaned into the S&P cap-weighted index over the last few years, where it's dominated by those 10 or dozen companies, and you start looking day to day, week to week at having to lean on those companies so strongly for index performance. But historically, go back to the 90s, when I first started trading, 2000s, we had very healthy moves, sector to sector, rotation. That hasn't really been the case over the last real strong move. Earlier, some of the guests called it, say, 2008 through today as the bullish move. And where I really saw the market cap names take off was post-2011. And if you didn't own a lot of those names, you know, you've struggled in performance. So, you know, fortunately, we've kind of tagged along there. I mentioned 2011 because a lot of people forget that from June to November in 2011, S&P was down a tick below 20%. So I try to stay away from names like bullish and bearish. What I'm seeing as a positive right now, and it's fooled us a couple times the last few years, but in answering your question, Bill, I'm encouraged by the small cap and micro cap indexes over the last 4 to 8 weeks. They held up better in the pullback, and that's all a 10% move down is, right? Let's face it, there's been zero volatility. We get a little bit, you know, inured to downside risk, and then we get a 10% pullback, and there's crisis headlines on the media. The reality is we need that kind of volatility to create opportunity. And I'm encouraged by what I'm seeing in the small cap space, which maybe can take some of that bulk off the FANG stocks, so to speak.
Okay.
If you look at them pulling back only about 60% of the S&P over the last 8 weeks, and trading down just this week where we did, traded down. I'm not big on an exact test of a previous low. Look at it more as a range, but your small caps didn't trade anywhere close to the early February lows, while the S&P did, while the Dow did. That's a relative strength signal that there's less selling in a space, more demand, and that should be positive for the broad market going forward. I'd love to get away from these FANGs. I own them individually. We own them. It's not healthy to have to lean on half a dozen stocks week to week.
Yeah, that is incredibly powerful that the small caps, in theory, where the risk would be, right? Smaller companies held up so well. I'll just make a quick comment about the FANGs, and just if anyone out there doesn't know FANGs, Facebook, Amazon, Apple, Netflix, Google, right? The FANG stocks. So they are all part of the 10 largest stocks, and I got to give credit where credit is due. If anybody looks at the work of Strategas Research Partners, Jason Trennett's firm up in New York, their technical strategist, Chris Verone, sent me a great piece of data a couple of days ago, noting that the 10 largest stocks, again, the FANGs are part of that, at this point only account for about 16% of the S&P 500. Now you might say, whoa, 10 stocks account for 16%? Actually, and this was why the data was important, he went back and looked at how much the 10 largest stocks in the S&P 500 represent in percentage terms going, way back. And he found that you only have sort of a crisis, and 2000 was the classic when the tech bubble happened. You only have a crisis when that number gets up to about 22 to 23%. In other words, so we think that we're really concentrated, but we're actually not. I was fascinated. Again, that's not my stat. That came from Chris Verone of Strategas. So if you're stressed out about the FANGs being too big, don't stress.
You were just as concentrated in the late 60s as you were in the FANG stocks.
Explain what do you mean?
Well, you had everybody piling into the Nifty 50 stocks.
Oh, right, yeah.
And then they peaked in January 73, and the Dow lost 46% of its value.
Yeah, and that too was like a 22 to 23% concentration.
Exactly right.
Yeah, right. Thank you.
So I have one last policy question, and then we can get into sectors. Jack Ma, most of you hopefully know, founder of the e-commerce giant Alibaba, based in China. He gave the following quote at the latest Davos meeting: "China and the U.S. will never have a trade war. Give Trump some time. He's open-minded."
Who said that?
Do you think trade actually matters for the stock market? The saber rattling we're seeing from a protectionist standpoint, does it really matter? Or is there a way to play that theme within sectors or individual companies, which could be a small cap, mid cap sort of play as well? Any views on that?
I mean, I working with an economist, a free market economist, very free trade, you don't want to construct barriers to trade. It will make us worse off as a country. It'll raise our cost of goods. But there is, in this negotiation, China has been getting our intellectual property in a way that nobody's really pushed back on. And so even from my libertarian free market economist mentor says there's something to this negotiation that we should actually push back to China. And so now the question will always be the devil in the details, how it all plays out, what actually happened, and it's way too early to know how it all plays out. But the fact that we're negotiating isn't a bad thing. Now, how it plays out, we don't want all these huge barriers to trade, and that could become a problem. But I think for now, you're willing to say this is a negotiation, and we'll see where it plays out.
So for now, maybe avoid the noise, focus on fundamentals, focus on earnings, and let the trade discussions go where they will.
Yeah, before this started, there were already notionally 100,000 tariffs around the world. So the big brouhaha about the few that have been put in place, I think cooler heads are going to prevail. I think the most important thing that came out the night before China retaliated, if you want to call it that, was that the Chinese said, we are open for negotiation.
Okay.
Yeah, in fact, let me give you a couple of numbers that I think should give people in this room some comfort. And I think it's also why the markets are responding as they are, which is rising as opposed to falling day after day. When the steel and aluminum tariffs were first announced, everyone was saying, well, this is about Chinese steel. Actually, it's not. Only 1.5% of Chinese steel ever finds its way to U.S. shores. And in fact, China accounts for less than 2% of the steel we import. So it was never about Chinese steel. This was about gaining leverage in the NAFTA negotiations. Canada and Mexico together account for 1/4 of the steel that we import. And within about 36 hours of the so-called tariffs being erected, there was already a carve-out for, you guessed it, Canada and Mexico, because we wanted to, quote-unquote, act in good faith. So what I think Mr. Trump is doing is just taking a page out of his own book, The Art of the Deal. It may be uncomfortable, but this is what he does. He stakes out an extremely extremist position, and then he sort of comes to the middle and gives ground. I think we are literally witnessing some version of reality TV playing out every day, and it's called Let's Negotiate, right? And that's what's happening right now. And even with the Chinese tariffs, again, a couple of numbers, our original tariffs that we proposed on the Chinese amounted to about 1/10 of what we import from China, and their first response was 1/10 the size of ours. That's incredibly measured. Now, as we find out a week later, 2 days ago, they come out and they say, well, actually, we're going to erect tariffs, potentially, on 50 trillion, which is actually the same number, or 50 trillion, excuse me, 50 billion, the same number that we had effectively imposed. So now it's a tit for tat, except, well, we, the U.S., have said, well, but you know what, they're not going to actually happen until June, right? Negotiations. So that's, it may be ugly, it may be weird, it may be uncomfortable, but actually, there is some legitimacy to what's happening. I've done business with the Chinese. They don't make it easy, and they want your numbers. I mean, when I was trading oil, and they asked me to submit bids, we basically rented a couple of old tankers and parked them off the coast and filled them with oil because this was 15 years ago. They didn't yet have heating oil tanks and pipelines built, so they had to store floating storage. That was the only way they could do it. We ran the numbers, and we basically made them an offer. Here's where we can supply heating oil to this, city, and we had built in basically a 10% margin for ourselves. Well, they came back and they said, at that price we can do it ourselves. Why don't you rerun the numbers? They'd already run the numbers. All right, they knew it, and they basically were holding us to an 8% margin. And I could give you some of the other details, but I won't bother you. Suffice to say, they're a really tough competitor to go up against, and they know their stuff. And the fact that you actually need an onshore partner to actually get deals like that done, so that they can actually figure out how you're doing it, is exactly, I think, what, without giving anyone too much credit, someone in the White House is trying to go up against. So I think it's all about negotiation. It's uncomfortable, but I'm getting more comfortable with it. Sorry I talked so long. You get me wound up and I just go. I apologize.
That's great. So I want to turn to a theme that's important for our clients at Field Point Private, which is this idea of deregulation. And we're seeing deregulation having material impact on two particular sectors: the energy sector and the financial sector, particularly for the banks. And this is important because initially the thought was you don't have to change the law, you just have to change the people interpreting the law. And that change has occurred, and we're starting to see deregulation occur in those two sectors just by the interpretation of the laws that are currently on the books. However, Chris Whalen's going to be coming up next. He's going to be talking about the banking sector. We're going to hear about some of the deregulation there. We have begun to see changes in banking law, and loosening up of some of the Dodd-Frank provisions. Could we just talk a little bit about the financial sector or the energy sector and particularly the financial and banking sector, very important for the economy, very important for the markets. What's the view from the panelist? Matt?
Well, to give you an idea of how we're positioned in there, we like financials, specifically banks, an awful lot. We have a dead overweight position split between the large banks and regional banks. So we like both. We've dug down deep enough to even look at community banks. We run into a little bit of a liquidity situation there, getting in and out of trades, which, again, an individual trading can look differently at that. We like the community banks an awful lot, and we're working on seeing if we can get enough liquidity to take a position there. So what's the S&P, David? About 15% financials right now, and we're sitting at 24 and change. So we're plus 10. Shows you our thoughts there. And I think not only the deregulation, but as rates continue to creep up, as they have over the last 12 months, you're getting a little bit of breathing room back into the banks from a spread standpoint, so they can start making a little bit of money there. And just on that rate comment, I'm sure John Musso touched on it this morning. We're not afraid at all of higher rates. We actually would like to see them, as long as it's not a spike in higher rates. If we could crawl from this 280 on the 10-year, 24 months out, be maybe at a 340 or 350, I think the markets handle that beautifully. It also gives the bond investor some income, which from a standpoint of having clients, that's been a real tough scenario over the last 5 or 6 years. So rates can help in a number of ways, but specifically in the banks. So we're overweight there.
Yeah, I like the little banks a lot. I think there's a big consolidation move there.
We're a little bank. We like that, Jeff.
Yeah, well.
We're a real little bank.
I'll speak on the energy, because you mentioned that. I think there's a huge disconnect on the energy stocks and the price of crude oil. The energy complex is trading at the same valuation metrics they were trading at when crude oil was at $26 a barrel. And now crude oil's at about, 62, 63 bucks a barrel. So a lot of the money that I put back to work yesterday actually went into midstream master limited partnerships. They yield 6, 7, 8%. Most of them have already cut their distributions. They don't have exposure to crude oil. Because they own you can think of them as a transportation company without wheels, because they own the pipes and the storage. They have long-term contracts with Exxon and Chevron and people like that. So I like the energy space here. I also like the financials a lot, and I still like tech. I just don't like Facebook. I think Facebook is broken. I think it's going to take them a long time to fix it.
Jeremy, question for you. We had the panel earlier that talked about technical analysis, quantitative analysis. What are the indicators that you look at and your team at Wisdom Tree to assess where the value is in the market, where the opportunity is, and what are those indicators telling you right now?
Yeah, I started off earlier just with the big picture of this equity premium as, if you think about how do you create a long-term view of the market, this earnings yield and bond yields metric is really a big picture, more 5 to 10 year view. It's not a short-term indicator because valuations don't always work in the short run, but in the long run, say, where do I think the equity markets are going to go? Having that anchor of, well, the S&P's at a 5% earnings yield, you get 2% inflation, so there's 7% longer-term return from U.S. large caps. That's how I think long-term. In the short run, we've been doing a lot more work about, well, is there anything dynamically you can do to determine how exposed you want to be? Is there risk indicators or hedging indicators you could follow? And I think there's a lot of people have looked at, and in the press right now, you're hearing a lot about the 200-day moving average. You hear a lot about these technical patterns. We've got 2 different models that we look at that's slightly different than both of those. One we wrote about on a blog recently. It's called, what do rising correlations signal for the market? And how stocks interact with each other and the correlation between stocks, we found to be this risk indicator that as you get spikes in correlation, it sort of signals more things to come. So the last 2 years, of the 24 months before this year, only 2 months of those 24 did you have our risk indicator flashing. In January and February, it was flashing, and it would have suggested sort of reduced exposures. It's still there today, so on this sort of short-term indicator, the rising correlations is somewhat a negative. We do have this other fundamental-driven model that looks at earnings momentum and valuations, and that today, and largely for the last 2-3 years, earnings momentum has been so strong, it's really kept you in. Valuations are at that cutting edge of, historically they're not cheap, they're not super cheap, but the earnings momentum has kept you strong enough. But we look at these, whether it's an earnings momentum and valuation model combined with our correlation hedging indicator, it's some of these things that we're thinking about as sort of dynamic risk exposures.
Okay, thank you. So I do want to give an opportunity for the audience to ask a couple of questions, but before we do that, I'm going to ask you guys to put your necks on the line for just 1 second. Your single best idea could be a stock, could be a sector, could be a country between now and the end of 2018.
Raymond James.
If I'll stick with the U.S., I sort of this small cap. We have a small cap earnings strategy. The PEs today are 13 to 14 times. I mean, I think that's low, not just compared to where it is where everybody else is today. 13 to 14 times for a small cap basket. Rates moving up, cyclical momentum on the U.S. economy. I think that's my favorite of our different strategies today. So EES is our ETF on that small cap earnings. What is it? EES.
Adam?
Google. It's the most innovative, fastest growing, cheapest $1,000 stock I know.
I like Google as well, and I like small caps as well. So let me go in a different direction. I'll just talk our own book and say I think the rest of 18 through the first half of 19, you'll still see good, steady bid and good, steady returns in the regional banks. So I'd say the risk reward, because you can always look at where you think something's going to go, but what is the risk in owning that position? And I think the risk in banks with a little bit of a wind at their back is contained. And we talk an awful lot in our trading room about containing risk. If you can contain risk, we'll let the upside take care of itself. And I think the risk is fairly contained in the banks, and you have some nice upside there.
That's the main theme running through The Intelligent Investor. The book Warren Buffett said is the best investment book ever written by Benjamin Graham. The quote from Dr. Graham is, "The essence of portfolio management is the management of risks, not the management of returns." And he closes that thought by saying, all good portfolio management begins and ends with this premise.
Agree 100%.
Amen. Okay, so are there any questions from the audience? Yes, sir, right here in the middle.
Yes, I have a question. I'd like to direct at Matt. I believe you made the comment that the vast majority of your equity positions are long-term. Do you have any thoughts about the industry we saw 5 or 6 years ago emerge, the 3D technology? Do you like that? I don't think they've made, their earnings have not been there, but is that a buy from you or anyone else on the panel?
Is this a question for me?
To you, primarily, yes.
Thank you for your question, by the way. It's so weird. 3D printing was supposed to change the world, and it hasn't yet. That said, I have been long, though I just sold it, Dassault Systems out of France, because the stock already ran. It was like 30% in 12 weeks. How could I, justify holding that? I always have a place at which I'm willing to buy, and then I have a target, because as my mentor said way back when, you're only rational once, and it's before you buy the stock, so set your target then. And a stop. So Dassault has already run, but what Dassault's doing is partnering with Boeing to, thanks to some really cool new technology, print parts for jet engines on site. And what they do, it's really cool. They powderize metal. They literally take a hunk of metal and they powderize it. They turn these tiny, tiny little powder pieces of metal. And then they, using a process called laser sintering, are able to basically print a layer of powder, and then zoom, they zap it, and then they print, they lay down another layer and zap it, and what you're able to do is create these incredibly intricate lattice structures, right? Because, you're printing it in pieces, so the center of it can be hollow. That's what's really cool. I'm not really sure how many individual companies, other than Dassault Systems, which is already run through my target, are really doing that. It's a function that's getting internalized. So, Boeing's now doing it on its own. GE is doing it on its own. Honeywell's doing it on its own. I wish there were a more obvious way for us to play it. I hope that answers the question.
Other questions? Yes, sir.
Does anyone have any suggestions about investing in the blockchain technology?
I was just thinking, from when you're saying you wish there was a way to 3D is going to change the world, blockchain is going to change the world, and you say, how can you execute against blockchain?
Right.
And there are ETFs there that are some startup ETFs that are actually investing in the companies that are going to leverage the technology, and there's a few out there. So I'd take a look at some of those that came out that are the companies most involved in it. So it's not the cryptocurrency itself, but the ecosystem, the companies that are surrounded in it.
Right now, we've looked at a few of those, and they tend to be not very different than a tech basket. I think Microsoft's the largest holding of that new BLOK block for blockchain. And you look at it, and then you pull up, say XLK or a tech basket, and the weightings on the top 10 are almost the same. So it's tricky right now outside of some individual names, and that'll come around. I'm still waiting to go to the paperless office. Whatever happened to that? I mean, talk about three. Remember Triple D? You mentioned three. I was trading that 15 years ago. Okay, but simple. What the heck happened to the paperless office?
Do you highlight stuff, like print it out and highlight? Because I do.
Yeah.
Are any of you buying General Electric stock?
No.
Yes! I'm an idiot.
We own it inside of the industrial space that we own. We don't. We get our equity exposure through ETFs. So we're an index and basket trader, investor, buyer, seller. You mentioned GE, and John Mousseau ran out just a minute ago, but he hit me with a quick note yesterday. He said, is there any downside left in ExxonMobil? And it reminds me a little bit of GE, except probably a better run scenario where you're at a 4+ dividend yield. Probably going to make $5.50, $5.75 next year. Not this year, next year. Nobody believes that crude's going to stay where it is, so the energy stocks can't rally. Jeff mentioned this disconnect between the price of the barrel and the equity. Wow. We've been nibbling, hate to tell you, we've been nibbling on the energy space for about a year. We're fine because we just keep nibbling. It's a below market piece right now, but it's getting bigger. I ran some numbers, as I was saying with John, on ExxonMobil. I said, that's a classic buy it in your IRA, tuck it away, and look in 3 to 5 years, sitting on a 4.25 dividend yield at about, 14, 15 times earnings. Just GE reminded me of that. That's fine.
Yeah, a few weeks ago, the energy sector dropped below 5% weighting in the S&P 500.
Correct, and that's traditionally been a buy signal. David uses some work on the upside. We trimmed technology, by the way, last fall. So for a couple months there, we were biting, kicking ourselves a bit, but it really hasn't outperformed substantially in 2018. We took technology down. One of the reasons it got up to 25% of the S&P, 25% weighting in the S&P. There are times when a sector will run through that and technology did in 2000. It got up to 31%, 32% of the S&P. Excluding that 25 number, while it's not a bell ringer, you know, the bell doesn't ring and the sector fall apart, it tends to be a tougher spot for earning, you know, really earning something in your portfolio. So we took some technology off the table. One of the main reasons, Jeff, because you mentioned the 5% on energy, was we reached 25% on technology in the S&P. So the 5% on energy is very interesting and probably have de-risked some of that trade.
I wanted to ask you guys how you felt about Tesla, and specifically, what would you say the probability of default is over the next 12 to 18 months?
You know, it's fascinating. Actually, a good buddy of mine, a very savvy guy who trades collateralized debt obligations, CDOs, which I don't even understand, emailed me about it as well. And he was like, should I be buying these bonds? And I guess they're trading in the high 80s. And I don't know, the coupon's like 6%. And I said, no, intuitively, I don't think that's high enough. So my guess is Tesla is going lower. And given the fact that so many engineers and senior executives are leaving, I, as a fundamental stock analyst, can't get excited when I see that kind of activity. That's just my take, without ever having looked at the numbers, just a quick take.
No credit analyst on the panel.
No, but I do agree that the narrow spreads between investment grade and high yield, or you know, now that Tesla's considered a high yield, a junk debt, probably isn't enough for me to get excited about it. You know, there always is a point where it makes sense to take that risk. Probably not now. You know, and that goes along. You know, sometimes if you like a technology and like what's happening, you can almost outsmart yourself. You know, getting in, even looking at convertible ways to get into the equity and this and that, and you're better off just buying the stock. You know, one thing, and Bill, I'll throw it back to you. One thing I've found over, you know, the 25 years of trading is most of my better gains long term were initiated with small positions that didn't keep me up at night. I'm just talking about in a personal portfolio. You know, when I look at, say, Google or an Apple that I nibbled on here or there, yes, they're volatile. Yes, they were, you know, could they win? Could they, or was someone going to put them out of business? Was, you know, Google has no moat around it. Anyone can become a search engine. That was the story 10 or 12 years ago, right? But because the position was small in my portfolio or small in a client's portfolio, it didn't bother me. So my thought always, and it's a conversation we have with clients, is if you like something aggressive and you believe in the technology, buy the technology, but buy it at a number below your sleeping level. You know, and that doesn't tempt you to sell it, because Amazon over the last 15 years has pulled back 40% a dozen times. You know how many people have sold Amazon? Most people. If it was 1% or 2% of your portfolio, maybe you wouldn't have sold it, because it wasn't affecting you emotionally. So I think of Tesla like that. You know, just put a thimbleful in, and the debt's too far, well above my pay level. You know, maybe John has some comments.
Chris, I would say in the last 8 years, there's a handful of industries and even more companies that have been allowed to survive because of free money. Zero interest rates allowed a lot of stuff to happen that could not have happened under a normal monetary interest rate sort of environment. I would put the fracking industry in that camp. In fact, there's an argument that the Fed allowed energy independence in the United States to take place because of zero interest rates and the monetary policy. I think the fracking industry has matured to the point where there are clear winners and losers. I'm not sure Tesla's in that camp. I'm not sure there are any clear winners in that particular story, particularly as we're seeing the cost of capital rise as interest rates go up. Okay, we have to finish this on something more positive than what I said. So, are you a student?
No, I'm here actually privately.
Well, that was actually a compliment. You look so young. We're so glad you're here. Thank you.
I am actually going to say a little bit on the technology to any person who wants to answer this. AI technologies, especially with some of the advancements of robotics, is this something that you see potentially very heavily in our future? And if so, companies that you feel could be leading the way?
Yep. Yeah, companies. Okay, I'm your company guy. So yeah, AI or artificial intelligence is everywhere. In the same way that every company now is a technology company, right? I mean, if you're an Exxon, you're a technology company because you're using, all of the different modeling underground, and you're steering your horizontal drill bits with GPS technology, 5,000 feet away from where the drill bit, right? So every single company is a technology company, and I think that AI is becoming so much a part of technology that it's just there. It's like, this is going to sound like, where'd you come up with that analogy? But I'm just telling you what's coming to my mind. Native Americans don't have a separate word for religion because they can't imagine that there would be something separate away from the way they live their lives every day, right? And I think it's the same with AI. It's just going to become so synonymous with technology in general that we won't really even think about it.
And if you wanted to dig around on some companies on your own, there's two ETFs. What I sometimes like to do is go into an ETF in a hot area, like robotics, and take a look at their top 10, and that gives me a study list. So Robo, R-O-B-O, is one ETF. Another is BOTZ, B-O-T-Z. So if you pulled those up, now you could get into the AI space through either of those. But if you wanted to start to look at some of the companies specifically working in that area, that's a good place to start.
Before we close the panel, maybe I can make two observations. A stock mentioned here by the name of Amazon has had a little controversy in case you've missed it. So I looked at Amazon and I looked at a number, and let me just offer these numbers. In the last presidential campaign, the winner in the United States received approximately 62 million votes. The loser received approximately 64 million votes. Sum the two together, you do the math, 135 million Americans vote for Amazon with their pocketbook almost every day. Now, I don't know what that means, but if I were a politician, I would wonder about what I was doing. Second point, when you raise the long-term interest rate, which has happened, you change the math of the discounting mechanism that a company has for its unfunded pension liability, because its assumption is based upon an interest rate. So if the interest rate is higher, the unfunded liability backlog in American companies and other places is lower. When that happens, the earnings of companies, last time I checked, their experts are here, go up. Those two observations and the remaining Bitcoin, which are on the stage for you to help yourself to, lead me to the last housekeeping. We're going to take a break. There's some refreshments. We're going to come back, and we'll come back a few minutes earlier because we finished this wonderful panel and I stole 5 minutes back from Bill. We'll listen to Chris Whalen, who will talk about the banking system. Matthew, after we hear him, we may sell all of our banks. We don't know. And after that, the last panel will deal with the global outlook, China, Japan, and then we'll break for a reception. I'm being told something. I don't know.
Book signing?
Okay, I'll get there. And during the reception, which is going to be where, Jill? Right out here, right in the courtyard, Chris Whalen will sign his copies of his new book. It's a wonderful book. It's about the Fords. I won't say more. I'll leave that because he'll sign books for you. I encourage him to write books. I have done that for years. I read them, and then I have to think about what I read. It's terrific. So earlier in the panel, somebody was talking about the deficit and the debt. Who asked that question? Dick Covey asked that question. Was it Dick Covey? And how much debt we're accumulating and the deficits and how big they are. And it reminds me of a story. And the story goes back to the Middle East about 125 years ago. And it was the time when the British occupied the region after the fall of the Turkish Empire, and they built a narrow gauge railroad. And the railroad went from Istanbul to Alexandria, and it went along the coast. Now you might say, what does that have to do with all the debt and the deficit? The lesson from the railroad was the construction of the railroad. So here was this narrow gauge track running across the desert, and the maiden voyage or trip of the engineer and the train from Istanbul to Alexandria was taking place. And at the time, there was a Bedouin tribesman who was walking across the desert, and he quickly saw the railroad ties across the sand. And within a matter of a minute, he figured out it was a lot easier to walk from tie to tie to tie than it was on the sand. And he started to walk in the direction of Alexandria. The engineer looks out and sees the Bedouin with his back to the train and walking in the direction of Alexandria. And of course, in those days, these were steam engines. And the engineer wants to warn him. So he pulls the steam whistle. Ooh. The tribesman has never seen a railroad before. He's never seen a train before. He's never seen the tracks before. He has never heard a steam whistle. So he continues walking. The train is getting closer. The engineer really pulls on the whistle, and he goes, woo! No motion, keeps walking. Finally, the train is very close. The engineer running the train is afraid he's going to hit him. So he throws the metal clanking into reverse, which is what you did on a steam engine. You put the wheels in reverse, and the engine is slowing, the train is slowing. There's all this noise and racket and metal grinding, and he pulls on the steam whistle. Woo! The tribesman turns around just as the train hits him, knocks him unconscious. They put him in the train, they take him to the nearest hospital, which is in the Sinai Desert, and it's a British hospital. And he awakens on the second floor of the hospital. He's in a bed, in a room. He's in between sheets. He's bathed. He has never been in a building. He's thinking to himself, I died, and I'm in heaven. This is what it's like. He feels himself. He's alone in the room. It's the last room before the kitchenette on the second floor of a British hospital 125 years ago. So he gets up, he starts to look around, walks out through the door, goes towards the kitchenette, and as he's walking into the kitchenette, it's 4 o'clock in the afternoon. What happens in a British hospital 125 years ago at 4 o'clock in the afternoon? It's tea. The kettle is coming to a boil. Just as he walks into the room, the kettle starts to whistle. He grabs the kettle and he starts to bang it and smash it everywhere. And they hear this racket and they come in and they hold him and they grab him and they say, Muhammad, what's going on? What's the matter with you? And he says, you have to kill these things when they're small. Banking crises and deficits. You have to kill these things when they're small. This is Christopher Whalen, my adopted son. He will scare the pants off you.
Thank you, David. Yeah, I got to know David many years ago. I think it was just a phone call. He said, come fishing. He had found me through some of my writings, and sure enough, I went fishing in Maine, and we became very good friends. A couple years into our relationship, one day he comes up to me at the edge of the lake with a glass of wine in his hand, of course, and he says, this was right after the financial crisis, and he says, Chris, write the book. And I'm like, book? He says, write the book, and he walks away. So I go home, and I get this phone call about a week later from Wiley. And they say, Mr. Whalen, we understand you're writing a book. And I said, oh, yeah, I'll get you the outline, in a week or two. And I did, and that turned into my first book, Inflated, which I basically wrote in 3 months. That's how you write books. You get up at 5 in the morning, and you write for 3 or 4 hours every day. That's how it happens. The book we're going to be signing after the program today actually took a lot longer. And then I put it aside because I had been working at Bear Stearns and I had met Bill Ford and Jacques Nasser and everything, and it was a mess. And I said, I'm not going to end the book here. We don't have a happy ending. So I waited 10 years, and they find this guy named Alan Mullally, who didn't know anything about cars, but he knew a lot about airplanes. And he had been passed over to become CEO of Boeing, which was a rather dramatic mistake. But it was great for Ford because he came in and restored rationality and sanity to that story for at least a few years, and then unfortunately left. And what it teaches you is that there's always life cycles in companies and markets. And to me, as an analyst, the thing I've always enjoyed the most is not just the numbers, but understanding the qualitative aspects behind the numbers. When I was listening earlier today to the discussion about Bloomberg, it reminded me of when I was an advisor to Villanova's business school. I'm a Villanova graduate, and Wildcats. And they had done the same thing. They teach the kids how to use a Bloomberg terminal. They get certified, and it's a really good idea because it helps them get jobs. The Villanova Business School places 99% of their graduates. And I said to them, forget about the rankings. Just tell the parents the kids are going to get jobs. That's it, right? And, so the one thing I used to say to the kids when I worked with them, I got to look at their portfolio strategy. Somebody actually endowed them with $10 million that the kids are allowed to manage. And at the end of every semester, they have to go through what they did and why, and you get to critique it. And I looked at them and I said, always remember that not all knowledge is inside the Bloomberg terminal. Or as I put it to them, I said, how will you know when the Bloomberg is wrong? Because they do a very good job of gathering data and from all over the world and putting it in a very usable fashion. But oftentimes, especially when you go over long series of data over many years, things change so much in the economy and the marketplace and in the participants that the numbers from 20 years ago, even if they're the same, don't mean the same thing. So today we're talking about banks. How are banks? Well, if you read the newspaper or get on the Bloomberg terminal, things are just peachy. Banks have lots of capital. They're profitable again. They're bigger. In fact, they have too much capital. You're not allowed to say that, but it's the truth. And by and large, everybody has forgotten about the crisis of 10 years ago and how it very literally almost brought the US financial system down. In order to avoid that unfortunate occurrence, our friends at the Fed had to do some rather extraordinary things. They had to go beyond the realms of science and reason and go into that special realm that's just for economists, where they get to pretend that none of the things that they teach in math or physics or chemistry apply to them. And in particular, this notion that a positive number and a negative number have equal value and equal weight in economic terms. And so you had the US, Europeans, and I think even the Bank of Japan was first, engage in a process of lowering interest rates to just about nothing or even negative terms in order to essentially make the world safe for debtors. You know, earlier on the panel you heard our colleagues talking about the fact that equity premiums are well above average. Well, of course they are. Because really, since a friend of ours named Paul Volcker was chairman of the Fed, interest rates in the United States have slowly gone down. And the reason for this is that a guy named Hubert Humphrey and another guy named Augustus Hawkins from Los Angeles after World War II said that the Fed has to pursue full employment and price stability. There's actually three pieces to it, but we never talk about that. The stable interest rates, I think, was the third item. But full employment is the first in both political and economic terms. Well, if you don't have full employment, what do you do if you're at the Fed? You lower interest rates. And so they did. And we have successively lowered rates to the point where today, even though they've been increasing them for the past couple of years, they're still pretty low. What has this meant to depositors in particular, to savers? Everyone in this room is either a saver or advisor to a saver. What it means to them is that since the 80s, particularly after Chairman Volcker's tenure, you have seen a shift from depositors getting paid real returns in both real terms adjusted for inflation to a situation where almost all of the returns that are generated by banks go to equity. In 1984, more than half of the gross interest income of the banking industry went to depositors and bondholders. In 2015, during the worst parts of quantitative easing, just when they were finishing up their little experiment, less than 10% of the income generated by banks from loans, leases, their own investments, were actually going to depositors and bondholders. Even today, at the end of the fourth quarter of last year, banks only paid $20 billion in that quarter to fund $17 trillion in assets. Not too bad, huh? If we had that kind of leverage, we'd go out and do whatever we wanted. All of the rest went to equity. That skew is the reason that banks are profitable today. And you might think, whoa, wait a minute, Chris, what are you saying? Well, banks are savers and they're investors. And while the Fed has been helping them by keeping interest rates very low, keeping their cost of funds low, what else has happened to banks? Their return on their assets has fallen too. In 1984, the return on average assets for US banks was 1.25%. Today, it's barely 80 basis points. So over that period of time, they've lost enormous amounts of earnings power from their balance sheet. This has also put a premium on generating revenue from other sources besides interest. In other words, trading, anything that generates a fee. And when I look at the banking system today, I said it on CNBC this morning, what I see is an industry that looks a lot like the S&Ls in the 1980s. Now, we're not going to see a Paul Volcker kind of interest rate change where we drive short-term rates up to 20%, no. But I think what you're going to see is an industry where the good times in terms of expanding margins are behind us. The Fed maintained those margins. If you look at a chart, operating income for banks is steady, even after the crisis. It just bottomed a little bit for about a year, and it kept going up. How do you do that in the middle of a crisis when interest rates have been pushed down to zero? Well, they pushed the cost of funds down to zero, and banks still had enough earning power on their balance sheet to keep going. Today, though, when you look at the industry, last quarter, net income was about $40 billion. The gap between what they're paying depositors and what they earn on their assets is probably close to $70 billion. So even if we normalize a little bit and say to you, okay, we're not going to pay you $20 billion next quarter, we're going to pay you 25 or 30. Start to equalize that relationship again. Now, the banks would suffer an almost catastrophic loss of confidence on the part of investors. Because when investors look at banks, they think everything's fine. There's not a single analyst on Wall Street that follows financials that really digs into the numbers so that they understand how are these things operating as a business, how do they fund their assets, and how do they make money? If you look at the top 5 banks today, their biggest loan category is commercial loans. You know what the gross spread before funding costs is at, say, JP Morgan for commercial loans, big loans? It's 3.5%. That's not much, 3.5%. So when you look at it that way and you say, okay, the Fed, Mr. Bostic, all of his colleagues have said they're going to raise interest rates for the next couple of years with a target of, what is it, David, 4, 5% for short-term funds. The problem is that the ability of banks to either buy securities or make loans with much more earning power as we go through time is very limited, because the same dynamic that allowed the Fed to push interest rates down with quantitative easing and everything else that they did is capping returns on securities. You all know that. You're all in the investment world. Today, I think the biggest problem we face is that the Fed has decided that they want to normalize policy, but for banks, there's a constraint on what they can earn. You don't see banks out doing lots of securities deals. They're not allowed to trade for their own account anymore because of Dodd-Frank. So the ways that they make money are limited. And I'm not trying to say that I see, as I said before, an apocalyptic vision for banks, but I think you could see, as short-term rates go up, the yield curve is going to flatten, and you could see margins for banks getting squeezed. For me, this is going to be a lot of fun, because all the analysts that I know on the street have been selling this story that says margins are going to expand. That's not the case. The Fed already gave them margin expansion. They said your margins are not going to shrink between 2008 and really the end of quantitative easing, and they delivered on that promise. The Feds, remember, their key imperative, despite what the law says, is to make sure that the bond market is stable, that the Treasury has access to the bond market, and to protect primary dealers. Who owns the primary dealers who sell U.S. Treasuries today? Banks. They tried to save a lot of them after the crisis. Bear Stearns, Washington Mutual, a whole bunch of them went down. They couldn't save them. They had to go. Today, there's a very small group of dealers, and the Fed is very protective of banks as a result. But having said all that, the folks at the Fed, they may be economists, but they're not magicians. And I think the interesting thing going forward is that as we see the yield curve flatten, as we see interest rates try and go up, but they can't really because there's too much demand for paper. Everybody keeps talking about a 3% yield on the 10-year Treasury. Well, we're waiting, but every time it goes up, so many buyers come out of the woodwork that it gets forced back down. So I think we're going into interesting times for financials because they're healthy, as I said. They have lots of capital. But I think when you really look at the industry, the equity returns are much lower than they used to be. The asset returns are much lower than they used to be. JP Morgan doesn't even have a 1% return on assets. It used to be 1.35 10 years ago. So their ability to generate income has been constrained. And I think either we're going to allow them to take more risk down the road, or we're going to make other changes. But there's going to be a lot of pressure on policymakers to figure out how to prevent banks from turning into utilities, because that's really where they're headed. You know, before they were talking about the S&P, financials are 15% of the S&P. They were leading the charge last year. Even as we got into February, JP Morgan at $120 a share was almost 2 times book value. When I have a bank that's not even giving me double-digit equity returns at 2 times book, and I'm not buying the bank, then I'm not interested. You guys are probably wondering, what does Chris own? Cash? No. I own 3 stocks in my own portfolio, and then my beautiful wife over there has the rest of my money. I made the same choice, right? FinTech, PayPal. I've been in PayPal since it was in single digits. Square, which looks an awful lot like Visa and MasterCard in their early days. Stock has got up a lot. I keep thinking maybe I should sell it, but nah. Again, and then I own a REIT that none of you should buy, okay? I'm going to tell you about it anyway, because I spend most of my time in the mortgage industry. It's called New Residential. New Residential buys mortgage servicing rights. They buy whole loans. Why do I own it? Well, I know the guys who run it. I'm a consultant to one of their key partners, Ocwen, and it has a 12% yield. Now, why does a company that's run by Fortress, and you know, these are real people, why do they have to pay so much for equity? Well, part of the reason is nobody understands the sector. When you talk about REITs, whether they own buildings, whether they own mortgages, whatever it is, it's opaque. You could have a room full of lawyers and analysts going through their financials, and you'd never understand what is really going on. But the other key thing to look at, which affects banks, is that people in that industry, people in many other industries, are faced with assets that are well overpriced. When a company like New Residential is out buying mortgage servicing rights, the right to service your Fannie Mae or Freddie Mac loan is trading at a 7% yield. 7%. They pay 12% for their capital. What's wrong with this picture, right? You put the 2 lines together. Many, many other industries in the financial space have the same problem. When the Fed pushed down interest rates, they also forced investors to buy other things. They wanted that. But they skewed the entire credit market so that the available assets are so expensive that they don't make any sense. You know, in the old days, 4 or 5 years ago when I was working at a big distress servicer in California, you could buy bad loans and get a 25% yield. You go work with the borrower, you fix them, sell the house, whatever. Today, those same assets are in single digits. Why? Because BlackRock and PIMCO and all of the other buy-side players just showed up and said, we want it. We don't care what the yield is. That's the environment that the Fed has created. And financial institutions have to somehow navigate this environment, which is at least a little bit irrational, but it is what it is. It will normalize over time, but I would suggest to you that it's going to take a lot longer than our friends at the Fed think. You know, earlier one of our colleagues referred to the Fed reducing their portfolio. Well, they're not going to sell anything because they can't. If they sold any of their securities, they would take a loss. If the Fed takes a loss, they stop sending money to the Treasury. Then what happens? Republicans get unhappy. They hold hearings. They wave their arms. They have no idea. It doesn't matter. But you know, the dynamics that the Fed faces politically are really quite challenging. Members of Congress think the Fed is a source of revenue. They think that the remittances from the Fed to the Treasury are money that they can spend. It's almost Argentine. But that's the world we live in, and if you're running a bank, whether you're Jamie Dimon or our colleague Bill or anybody else who owns a financial institution, you have to make investment decisions and decisions about funding in a world which is still a little bit crazy and a little bit irrational. You know, we live in a democracy. This is what we get, right? I won't make any comments about the occupant of the White House, but you know, suffice to say, we get what we deserve. And I think from my perspective, earlier one of the panelists was talking about small banks. I love small banks. The smaller banks are where all the value is in the market. The $1 to $10 billion banks, those are the best performers in the industry. But you'll never hear me talking about that on CNBC because they're too small. There's no liquidity. In fact, if you get down as small as US Bancorp, BBT, Regions, SunTrust, those are too small for most institutional investors. Yeah. So this is, if you like financials, that's where I would tell you to look. But I would also tell you that the large caps, I think, are going to be under a bit of pressure over the next couple of years, simply because the subsidy from the Fed is slowly going to wane. So finally, let me tell you a quick qualitative story, and then we can do some questions. One of the fascinating things in the Ford book I did was that early on, like many businessmen, Henry had had several attempts, and they had all failed. In fact, the second company he was involved in eventually became Cadillac. It was bought by Bill Durant and rolled up into this thing called General Motors. But one thing I didn't accentuate enough in the book, and I wish I had, was the whole Ford story is about luck. It's about chance. It's about acts of God. Because here's a company that should have failed many times, and it didn't. And meanwhile, General Motors filed bankruptcy 4 times. At one point, they were kind of an appendage of DuPont. DuPont was providing all of the chemicals and paint and everything else, and eventually the Eisenhower administration tapped them on the shoulder and said, you really need to sell that. So it's an amazing comparison between the two. But one of the striking things was that one of the early shareholders of Ford, and Henry wasn't even an officer of the company when it was started, by the way, is Horace Dodge. The Dodge brothers, like Ford and like many other people in that industry, all started off in wagon shops. Why were they working in wagon shops in Detroit? Because all of their forebears had immigrated from Europe and come down the St. Lawrence Seaway. This is why all the major cities in eastern Canada are along the St. Lawrence Seaway. Horace and his brother were the parts makers to the auto industry. They built the first Fords as kids. They both died of the Spanish flu in 1915. If those 2 men hadn't died, they would be the people we talk about when you talk about the auto industry, and not Henry Ford. So I'll leave you with that. And I'd be happy to answer any questions you have, if you have any. Oh, go ahead.
Do you have any thoughts about Annaly Capital?
Yes, Annaly is a very large, it's the biggest REIT that invests in agency mortgage securities. It is much debated because everybody believes if the yield curve gets flat, that the company will get into trouble because the spread between their cost of funds, what they earn on their securities will diminish. The way I look at Annaly is, if we have a flat yield curve, they're slowly going to be forced to liquidate. Because the thing about Annaly is it has a lot of capital. They don't tend to even have debt ratings. They raise their money in the equity markets. But then they take all those mortgage backs they buy and they repo them out. That's how they get leverage. So if it gets into trouble, they'll just unwind the repo and sell them. It's not a stock I particularly like. I've always stayed away from the agency guys. I like people who own loans, and I like people who own mortgage servicing rights, which is another intangible asset, by the way. Probably shouldn't be, but it is. The accounting profession has 50 years worth of catching up to do when it comes to how we characterize a lot of assets that you see on the books of financial companies. They just don't know what to do. And I don't have much hope that they're going to catch up. Was there another question? Go ahead, sir.
What are your thoughts on business development corporations like Franklin Square, who came out in 2009 with a portfolio of senior floating rate loans that they had acquired from banks, insurance companies, and hedge funds because of the Dodd-Frank legislation. Yes. And they're now publicly traded on the New York Exchange. And I guess they're headed to a big merger over the next year or so with some other companies. But they have, in essence, behaved like a bank, I guess, financing a lot of loans to private companies. What do you see as an outlook for that type of a sector in the economy?
Well, for the same reasons that the banks had cheap costs of funds, and you saw the returns on assets fall, a lot of the assets that the BDCs were buying are mispriced. In other words, they were buying something that looked like a double B credit when it was really a single B credit because there was such competition for assets. Now, these are non-banks. They don't have deposits to fund their business, so they will either typically get term funding or issue debt or both. Then they have equity, but they can't run at big leverage ratios. They're not allowed to, 2 to 1. So I see them as vulnerable because as they reprice those assets, and remember, when times are good and the cost of funds is 0, you can hide a lot of mistakes. That's the whole thing about credit. I built the financial institutions team at Kroll Bond Ratings, and the thing I used to tell my kids, I call them kids, all the time, was that what you see is not correct. We had all these issuers coming in. In fact, you should go look at their website. They have rated half a dozen different BDCs. I think it might be helpful for you. But all of those portfolios are going to get repriced over time. And I think as you see default rates go up, which I expect, they're going to have to work it out. So there's a whole group of them, and they're all different. Yeah, go ahead.
And could you expand a little more on your view that net interest margins will decline as rates go up? I mean, we heard an optimistic story this morning about capital spending, so presumably the corporate demand for funds is going to go up. Why can't banks just raise their lending rates? And you mentioned JP Morgan's very low return on C&I loans. Why won't that go up?
Because it's very competitive, number one. When you're talking about big banks, they don't care about little loans. Your typical large bank has an average life on their book of about 4 to 5 years. What does that mean? It means 20% of their loans are maturing every year. They got to go out and replace them. And then if they want to grow, they got to go out and make more loans. So the pricing in that market is constrained right now. I'll give you a scary number. You know what the gross spread is for Citigroup? 1.5%. They have no pricing power in that market. How do they live? Credit cards. They have a big subprime consumer book that generates double-digit returns. So that works for them. But for other banks, Wells Fargo is actually a little bit above JP Morgan. And then you have Bank of America, which is a little below. They're all fighting for the same assets. And they're competing with pension funds, insurance companies. They're all out there hunting for assets, private equity funds. So I think in the short term, Martin, what I see is the cost of funds is going to rise faster than the return on assets. It's not that the returns won't rise, they'll rise slowly, but you got to wait for that whole balance sheet to reprice. If you're sitting there and you own a bunch of Ginnie Mae 3s, those securities are not going to prepay. They're going to be around forever. People forget FHA loans are assumable. Some of these loans may never be paid off. They'll just keep them. It'll stay with the house. So I think you have a latent effect in the asset market where the returns are just not going to rise that fast. Whereas if we have a lot of volatility, as we were talking about earlier, you could see the cost of funds rise faster.
One more question will be the last.
I thought your comments, by the way, thank you for those insights because it's not something I've heard before. So I appreciate that. But you talked about the 3 things that you own. What if you had another pile of money, which I assume you're going to get from this book? Where would you invest it if you had to do it now?
Well, I'm a financial guy, so I like to find situations that need to be fixed because I think there's opportunity there. We were talking before about regulation. Yes, we're starting to ameliorate some of the regulatory constraints that were put in place a decade ago. But remember, the guidance from the regulator who lives with you, your examiner who lives with your bank, is telling you to back off on a lot of assets. Multifamily, real estate. You've got a lot of that down here in Florida, right? What's happened to pricing on those assets? It's doubled over the last 7, 8 years. So the comptroller is telling all of the little banks around the country and the big banks, You may not exceed 300% of your equity on your exposures. This is a big deal in major cities because what do the mid-sized banks and small banks in New York City lend on? They lend on multifamily real estate. There's no construction lending right now. So I would look at areas where the regulators have constrained both banks and non-banks and try and get into that. I'm even seriously thinking about trying to put together a bank that just does construction lending and doesn't do anything else because it's a horribly underserved market. That's why we don't have any housing starts. So.
A sobering 30 minutes from Chris Whalen. When we fly on planes together, he sits in the no smiling section.